Good morning. Welcome back to the Retirement Report. This is Hank Parrott, your host, and we're talking investing this morning. You know, one of the things with the market and the volatility, I want to give, again, a little perspective here. So if we look at the S&P 500 index for 2017, the average return was approximately 22%. I think it was 21.8. All right, so that's the return for the S&P 500 index, the stock market, in 2017. Great year. Now, since that time, now understanding when we're talking about a correction, right, we're talking right now, if you're listening to any of the financial shows and all that, they're talking about a 10% correction. They're talking about 10% off the highs, which were actually reached in January. Okay, so if we look at year to date, however, so keep in mind, 2017, you got a 21, almost 22% increase, okay, return on your investment if you did as well as the S&P 500 index, the market. Down from that, just year to date now, forget about the 10% off the high. Let's just, because that was just running up into January and then we tailed off. But if we just look at year to date, we're only down about 3%. So let's see, I earned 21% last year, 22%, and I gave back about 3%. Not so bad. That's not a bad return overall still, right? I'm still up. That means about 18, 19% if I look back over, you know, from beginning of 2017 forward. And of course, the market was doing well before that. In terms of 2016, I think it was about almost a 10% return on the market as well. And as we go back, you know, the rates of return average on the S&P 500 index, if you look at it over the last 3 and 5 years, phenomenal. If you look even at the 10-year, you're looking at about an 8.5%, almost 9% return on your investment. And this goes to the portfolios I mentioned, where you can do the same kind of return, you know, in that 8 to 9% range over the last 10 years, but with a lower standard deviation, lower risk measure. I'll get into a little bit more about that. But first, I want to go back to this 3 worlds so I can finish out about variable annuities and how that works. Variable annuities, again, this is one of those if you're investing in the market, now we don't have any guarantees, right? Principal's not guaranteed, certainly no earnings guarantee, and this is a big one, right? You need time, you need to leave it invested. There's a term in the investing world, if you will, it's called rolling 10-year averages. A rolling 10-year average simply means that as long as you're invested in the market for at least 10 years, you have about a 95% chance that you're going to have a positive result. An exception would have been 2000 through 2009, right? There's that 5% time when the market did not give you a positive result for that 10-year period. But outside of that, and again, we're talking about the market, the S&P 500 index, the Dow Jones, about the same. But if a portfolio over that same period actually did have a positive result, you would have had on a $250,000 investment, let's say at the beginning of 2000, for instance, if you were invested in the market at the end of 09, you would have had $224,000 left. In other words, you'd have lost about 10% over that period. However, if you compare that to, say, a moderate portfolio over the same period, you'd have had a $150,000 gain on your money. So basically about a 60% increase, or an average of over the same period of almost 6% a year. Asset allocation is so important. All right, so variable annuities, what do? Well, here's a variable annuity is basically an instrument where you have an insurance product that has sub-accounts that are like mutual funds. And these sub-accounts, you've got extra fees. So you've got fees within the sub-accounts, much like with mutual funds, you're going to have fees or expense ratios and potentially sales loads, depending on what kind of, how you're investing. You got the same thing with the variable annuities. Plus, you can have other costs. You have mortality costs. You have admin costs. You have, and of course the investment costs we talk about, sub-account fees. And these can be quite high with actively managed sub-accounts, and actively managed mutual funds work the same way. So you can all of a sudden see within those, 3, 4, 5% or more in annual fees in a variable annuity, where in a portfolio, a properly constructed portfolio, even with an advisor fee, I'm looking at, maybe 1.2, 1 point, depending on how you're invested again. Now, some advisors charge 1, 1.5%, 2%, plus you have the fees within the funds. You may be, and transaction costs, depending on the amount of trading that's going on. And you could see 2 to 3% even there. Though typically more like 2.5% is probably going to be what you'd see. But again, we can cut that down. We can minimize costs, and that means more return in your pocket. And of course, if it's done correctly, that's the other piece. All right, and then that's the last thing, and I've talked about these before. And by the way, this is how your average return historically about 4 to 8, and actually that's increased. I'd say more like 5 to 9 now, depending on the type of portfolio, whether conservative or growth, or even aggressive growth. That's enough to stay ahead of inflation and taxes, isn't it? Now let's look at another thing. This is index CDs and index annuities, so we can round this out. So here's a way where we start with all the guarantees from this is that middle world there, the center of your screen. So we start with all the guarantees that we have with the world of protection and safety, right? In other words, principals guaranteed, some amount of earnings are guaranteed, and then you'll have also penalties for early withdrawal. So again, you want to match up the terms to what your financial plan to make sure that you have the appropriate amount of liquidity to take care of things. You have an emergency fund, all these kind of things. I'll talk about that in a moment. So historically, you're going to earn enough again to stay ahead of inflation and taxes. But here I'm going to start this again. You have a link to the world of, to the market, and that's going to help you as far as growth and potential. However, understand again, there are different index annuities out there. So there's some that have caps, there are some that have high fees. You want to avoid these. So that's why I was saying when we narrow down the universe of annuities, we get down out of 1,000 plus, we have it down to 25 or 30 where we don't have high fees, where we, and sometimes even zero fees, no caps, so we can, we're going to more fully participate in the market. And some volatility, some ways to manage volatility within them as well. And they're great, great products for the right ones. But again, finding the right ones is the key. In fact, this is a great time. So for the first 10 callers, I'll throw this out there again. If you'd like to learn more about how these things can work and how they can work for you, then all you need to do is call my office at 615-376-5325. We'll get that up on the screen for you. There you go, first 10 callers. So if you want a free retirement income analysis, what I'm talking by that is a comprehensive financial plan. It includes an investment analysis. We'll look at what you're doing currently, show you ways then what the future looks like if you continue to do that, what kind of volatility is there, and what you might see in a market like this with regard to the volatility reflected in your own portfolio, and going forward into a full-blown bear, what would happen. And we will have another bear. It's just part of the markets. The next thing is that we'll include an investment analysis, full comprehensive plan. We'll talk tax stuff, tax efficiency, and investing. This is another area when we look at your portfolio. How tax efficient is your portfolio, and how does it minimize taxes, or are you in fact getting a lot hitting every year, having to pay a lot more tax than you might otherwise need to? And the same thing when it comes if it's in 401ks or 403bs or TSP for you that are military or federal government, your thrift savings plan. All of these the same thing. Tax efficiency is a big part, but also when you go to take money out, how to minimize taxes. Just an analysis with a client this year. We're going to be able to save her just by how we do income over the next few years. We'll be able to save over the next 5, I think 6 years. It'll be able to save her around $15,000 to $20,000 in taxes. If you'd like to see that same kind of thing, be one of the first 10 callers, 615-376-5325. Tess is standing by to get your information. She'll send you out a little packet to fill out and a checklist of things to bring to your appointment with me. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, so we've covered variable annuities. We talked about fixed index annuities a little bit. So with index annuities, now we're tied to the market. Again, we're getting that same kind of return. If you'd like to know how those work and the right ones, that'll be a part of that as well. Okay, we'll take a look at the next slide. This is the roadmap. So what this ties in together. Roadmap, basically, this is just your foundational little financial plan. We look at what are your lifestyle expenses. In other words, how much does it cost each month to maintain your current standard of living, quality of life. It differs, right? According to, this is about your personal specific situation. So we use a lifestyle expense worksheet to help with this, but if you know that, maybe you budget, maybe you already know exactly what that number is. So then in that bottom left-hand corner, where I've got that little box, we fill that in. So if it's, if it's 4,000, 5,000, 8,000, 12,000, whatever that number is, that's where we put it. And then that we use as a guideline. So that means how much do you need to keep in your checking account, which we refer to as your operating fund, where you're paying your bills and monies are going in and monies are going out, and you want to keep a rolling balance of about 1 month of that expense. So again, if it's $5,000 a month that you spend, then you need $5,000 in your checking. If it's $10,000, $10,000, $20,000, $20,000. The numbers just work. The next part is in your emergency fund. So again, if it's $5,000, you need about 6 months worth of that expense in an emergency fund. So it's $5,000, that's $30,000 you need put away in an emergency fund for those unexpected things. We don't know what's going to happen, but something always does, right? So we've got the money set there, completely liquid, access it easily. And then the next would be a short-term fund. Now the short-term fund, it's not just an easy little formula like that. Now we look at what your situation is. In other words, how much over the next, say, 3 to 5 years, and this is very crucial, especially the next 3 years, to minimize volatility. We want to make sure that certain things were not in the market. Like if you're going to buy a car and you're going to spend $30,000 or $40,000 or whatever it might be, or $20,000, whatever, that amount needs to be set aside in a very stable, like a money market, savings checking, short-term maybe CD or fixed annuity if it's, say, 2 or 3 years out, where you're getting some interest, but your goal is that you don't want it invested in the market, have a volatile period like this, and all of a sudden the market drops 10% on you. And you had $40,000 set aside for a car, now it's $36,000, okay? So you want to be able to access those funds, and you don't want that invested in the market in such a way, or you want it in a very stable type of investment if you're looking to earn a little bit on it while we're in income. Maybe this is another place. If I'm looking at an income plan with a client, and we're doing, on your planning as an example, let's say over the next 3 years you're already retired, you're going to need to take money from your retirement accounts, from your savings, whatever it might be. Well, over the next 3 to 5 years, we want stability in that income. We don't want to all of a sudden have your income drop by 10% because the market dropped by 10, right? So we want to have that more stable. I've got many clients where almost all my clients, in fact, where we do this type of thing where we ladder in portfolios, or we ladder in things that will help, and by laddering they step up. In other words, we'll have something that's really stable so it minimizes risk and volatility, won't impact them in terms of, like in this period like this, it's hardly moved at all in these kind of investments. And what that does is allows them to take the income they need without worry, and yet we're still picking up a little bit of return at the same time. And in our long-term fund, and then we step it up. That's what laddering means. We simply step up then from that period. Now we got to, say we're looking at, okay, what about 3 to 7 or 5 to 7? What about in that period, or even 5 to 10? We can be a little more moderate there. We're going to be able to leave that money alone for, say, 3 to 5 years at least, and then we can invest, and we're going to be able to ride things out, and we'll adjust the plan, of course, as we go along. That's why we do reviews, regular reviews with my clients, because in the review process, we're going to see, well, how are we doing relative to what our original plan was, and do we need to do any tweaking to it, or are we doing great and just maintain? That's what we do. Each review is kind of take a look at that. Next piece, and of course life happens. So when life happens, we want to also say, well, how does that impact it? Is there anything that we need to do to adjust to these life events, whatever it might be? Children move back in, maybe take care of parent, some financial stress of one kind or another. Whatever it is, we adjust the plan, and we're able to incorporate that in, and still it's always about, again, maintaining your standard of living and quality of life no matter what life throws your way, right? All right, we've got some more about investing when we come back. We'll talk about that long-term fund, and then we're going to get into a little bit more. So join me here. We'll be right back on the Retirement Report.